I started investing back in 2006. It was 2 years before the great financial crisis of 2008. I remember vividly the headlines: market crash, recession fears, and most importantly, I remember my small portfolio at the time being down by 20%. At that time, I didn't know what I know now, so I was panicked. Luckily, I was a new grad at the time, primarily worried about doing well at my new job. But I wish I had a tool like ChatGPT at the time to help me rationally think through what to do next. Well, we have that tool today, and so I'm making use of it in light of the volatile market conditions that we find ourselves in today. So I asked it, what ETFs would you own if a recession hit tomorrow? And it gave me not just a list, but it gave me a strategic plan. In this video, I'm going to walk you through the 4 ETFs ChatGPT picked for a potential 2025 recession. More importantly, I'll point you to what it showed me actually works and what doesn't in a time like this, when everything feels like it's falling apart. All right, let's dive in. Recessions create fear, and fear is not a good emotion to have when you're trying to be a good investor. ChatGPT isn't perfectly rational, but as far as we know, it's not emotional either, which is a strong trait to have in an investment sidekick. So the first question I asked it was, which ETFs performed best in the 2008 and 2020 recessions? And within a few seconds, it provided me with a list. And the first thing I noticed was that the ETFs that performed well in the 2008 recession weren't the same ETFs that performed well in the 2020 recession. There was some minor overlap, but we'll come back to that in a minute. This first prompt pointed me to a really key insight. Not all recessions are the same, so we can't assume that what worked well in one will work well in another. 2008 was a recession fueled by the global financial crisis, which really impacted the foundational elements of our economy. When banks aren't healthy, the rest of the economy is not healthy. The 2020 recession was more of a crash. The economy was performing really well going into what was a sudden healthcare crisis. And so even though the outcome of that was a recession, it wasn't your garden variety recession, which presented opportunities for several different sectors to come out of it with a V-shaped recovery. And that's what you see indicated here. You see ETFs in the technology sector that outperformed, like the VGT and the QQQ, returning 45% and 48% respectively. So if we have a 2025 recession, is it going to be more like the 2008 recession, the 2020 recession, or something totally different? Let's keep going to find the answer to that question. I continue with another question to ChatGPT. Which sectors are least correlated to GDP contractions? These sectors are typically called defensive sectors. So you see consumer staples, healthcare, utilities, and precious metals like gold and silver. And one that I hadn't really thought about was insurance, both commercial and personal. At this point, I now had a list of over 20 potential ETFs that could fit the bill as recession-resistant investments. But how do I now pick from these 20 to arrive at the best opportunities for our portfolios? The great thing about ChatGPT is that you can actually ask it what questions to ask it. And that's exactly what I did. I asked it what questions or prompts I should use to analyze each ETF deeply. And it gave me these key questions to ask to evaluate each of the ETFs. What's the investment objective for each one? How have they performed over time? How much do they cost to buy? What holdings do they have? And how diversified are they? What risks do they present? And who provides the ETF? And what's their reputation in the industry? So I asked ChatGPT to evaluate each of those 20 ETFs using these questions to narrow them down to the 4 best ETFs to invest in during a recession. So here's a shorter version of the prompt template. You can pause the video right now and take a picture of this or write it down, and you can use this again for your own evaluation. So the first ETF that it recommended is one that we might all expect. It's the GLD ETF, which would be part of the precious metals sector of the market. It aims to perform like the price of gold, which is an inflation hedge. Its expense ratio is 0.4%, which would mean that for every $1,000 invested, it would cost you $4. Now, there are some cheaper alternatives like IAU, which is 0.25%. From a performance perspective, it's done very well. Over the last year, 43%. Over the last 10 years, 163%. However, from a risk perspective, these average returns could be higher or lower by 16%, which still represents a good return. Assuming this 43% went down by 15%, you still have a return of roughly 28%. This is the most important piece of our analysis, the summary. Gold has historically been a safe haven during economic downturns. It performed well both in 2008 and in the 2020 COVID pandemic. This is one of the very few ETFs that performed well in both recessions, and that makes it our top pick. And that's why it's earned a spot as the first pick on the list. If you don't like the GLD, you can look at the GDX, which tracks gold mining stocks. It's higher risk, but potentially higher reward. Or you can go with the IAU, which has a lower expense ratio than the GLD. The second pick on the list is the XLP, or the Consumer Staples ETF. So think toothpaste, think Coca-Cola, think groceries. It has a low expense ratio of 0.1%, and it's performed relatively well over the past year, 5 years, and over the past 10 years. It has a slightly lower volatility than the GLD. It holds some great consumer staple stocks like Procter & Gamble, Costco, Walmart, Coca-Cola, and PepsiCo. These are typically considered non-cyclical, meaning the demand for the products remain relatively stable regardless of economic conditions. Although we are in a tariff-induced recession, which could have an impact on the cost of inputs used to make the products made by the companies within this sector. I would expect this to perform better than the overall market. You want to do your own diligence on this one, as it might be prone to some tariff-induced fluctuations. An alternative to this one is the FSTA, which is a slightly smaller consumer staples ETF, but with slightly different performance characteristics to the XLP. All right, so let's move on from what people buy to how we get paid. Because during a recession, cash is king. The third ETF on the list is the SCHD. It's the Dow Jones US Dividend Index. It invests in 100 high dividend yielding stocks with a history of great cash flow, dividend growth, and conservative debt to equity ratios. The expense ratio on this one is 0.06, which is the lowest expense ratio of the 3 ETFs we've evaluated. Check out this performance. 1 year, 12%, 5 years, 67%, 10 years, 176%. It's been an outperformer and it pays you to own it. It's got some volatility to it, roughly 13% each year, which means it could be up or down 13% from its averages. It owns some solid stocks like Broadcom, Pepsi, Merck, Home Depot, and it has a diversified sector base as well. So is it suitable during recessions? Well, it's got moderate downside protection, but the reason we own this is to get paid during recessions. It is made up of 100 dividend payers, which allows us to collect income while we wait out the economic storm. The fourth one is one that you might not expect to be on this list because it tracks the entire stock market, not just focused on recession-proof or recession-resistant sectors, but the broad market as a whole. It's the VTI, the Vanguard Total Stock Market ETF. It's got an extremely low expense ratio. It's the lowest expense ratio of the list. 1 year performance of 11.21%, 5 year performance of 108%, and 10 year performance of 199%. So it broadly tracks the market. It's relatively more volatile than the rest of them at 18%. Its top holdings are the darlings of the market: Apple, Microsoft, Nvidia, Amazon, Meta Platforms, and its sectors track the sectors of the broader market. The VTI covers the entire market, which means that it covers stocks that are both sensitive and insensitive to economic downturns, which means that cyclical sectors will experience declines and non-cyclical sectors would stay stable. So why would I even include it on this list at all? For one major reason: we're long-term investors, which means that we are always invested in the market. We can't time when to exit and when to get back in. We're always dollar cost averaging into our investments, and the VTI gives us an opportunity to do that on a broad basis. Some of the best times to invest is when the market is down, and we want to take advantage of those opportunities to add dollars in during downturns so that we get to participate in the appreciation of those assets as they pull out of downturns, which they've done time and time again. If you don't like the VTI, you can invest in the VOO. It's slightly less diversified than the VTI. You can also invest in the SPLG, which tracks large cap stocks. It's got a lower cost, but similar structure to the VTI. So here's the thing: not every recession is the same. And to get away from emotional investing or fearful investing, we now have a tool in ChatGPT that's unemotional about the choices that we can make as investors. It's much faster, has more information, and can be the perfect sidekick for us as individual retail investors to make better decisions for our portfolios. So what do you think about these 4 ETFs that ChatGPT selected? Are you going to be adding these to your portfolio? Why don't you comment below? Also, you can watch this video about 3 great stocks that ChatGPT picked to invest in during a recession, or this video talking about the hidden risks of investing in the SCHD ETF. I look forward to seeing you in the next one.